September 16, 1992, London. The British government is buying pounds in enormous quantities, trying to keep its currency above a line drawn by the European exchange rate mechanism. Across the financial world, traders are doing the opposite. They are selling sterling. Britain had joined the ERM in October 1990, committing to keep the pound within a narrow range against other European currencies. The system was designed to create monetary stability, but Britain entered at a difficult moment. The economy was already weakening, inflation had been higher than Germany's, and British interest rates were increasingly constrained by the need to defend the exchange rate. Germany faced a different problem. Reunification had created inflationary pressure, and the Bundesbank maintained relatively tight monetary policy. That made the German mark attractive, while putting pressure on currencies tied to it. The Bank of England later described the central problem clearly. The needs of the British economy were increasingly at odds with the exchange rate commitment. By the summer of 1992, the contradiction was becoming harder to hide. Britain needed lower interest rates to support a weak economy, but lowering rates made sterling less attractive and threatened the ERM floor. Raising rates could support the pound, but risked making the recession worse. George Soros saw something else. He saw a policy system with two incompatible objectives. Soros was not a central banker. He was an investor running the Quantum Fund. His portfolio manager, Stanley Druckenmiller, had been building a position against sterling because he believed Britain could not maintain the ERM commitment indefinitely. Soros became convinced that the opportunity was much larger than an ordinary currency trade. The fund began borrowing pounds and selling them, while positioning itself in currencies expected to hold their value better. Reports published shortly after the crisis put the position at roughly $10 billion. Soros later said the fund's total position by Black Wednesday was close to that figure. The bet was simple in structure but enormous in scale. Borrow pounds, sell them, wait for the pound to fall, buy the pounds back more cheaply, return what had been borrowed. The difference would be the profit. But the trade required one thing: sterling had to break. By September, the pressure was spreading across Europe. Italy had already devalued the lira by 7% on September 13. 3 days later, the pound would face the same pressure. Then came a crucial signal from Germany. Comments attributed to Bundesbank President Helmut Schlesinger were interpreted by markets as suggesting that some European currencies might need realignment. The comments were later disputed, but the market had already heard the message it feared. Sterling came under heavier selling pressure. On the morning of September 16, the British authorities tried to defend the currency. The Bank of England bought sterling. The purchases were large, but the market kept selling. The government then reached for its most powerful remaining weapon: interest rates. The official rate was raised from 10% to 12%. It was an extraordinary move for an economy already struggling. But sterling remained near the floor. Then, at 2:15 in the afternoon, the government announced that rates would rise again to 15%. The increase was intended to take effect the following morning. It never did. The market had reached the point where promises were no longer enough. Traders were asking whether Britain actually had the economic capacity to keep defending the pound. Every pound the authorities bought represented another use of foreign reserves. Every interest rate increase made the domestic economy more painful to manage. The ERM had turned the exchange rate into a commitment that the government could not easily abandon without admitting that the market had been right. And the larger the defense became, the more attention it attracted. Soros was not alone. Banks, corporations, hedge funds, and other investors were also responding to the same economic signals. That matters because the legend often reduces Black Wednesday to one man defeating one central bank. The reality was larger. Soros made an enormous bet, but he was betting into a weakness that already existed. Britain was trying to maintain an exchange rate that increasingly conflicted with its domestic economic conditions. The Bank of England later recorded that massive intervention had failed to lift sterling from its ERM floor. By the evening, the decision was no longer whether Britain could win the fight. It was whether the government would continue paying an enormous price to keep fighting it. At 7:38 p.m., the answer came. Britain suspended sterling's membership of the ERM. The pound was no longer required to remain inside the old boundary. The defense had failed. The next morning, the number that mattered was no longer the ERM floor. It was the price of the pound in a free market. The planned 15% interest rate increase was cancelled, and the rate returned to 10%. Britain had left the mechanism that had forced monetary policy to follow the exchange rate. For George Soros, the trade was now working. The pounds he had sold could be bought back at a lower price. Contemporary reports said Soros made almost $1 billion from the position. That figure became one of the defining financial stories of the decade. The British government, meanwhile, faced the cost of the failed defense. The UK Treasury later estimated that Black Wednesday had cost more than £3 billion. The nickname followed quickly. George Soros became known as the man who broke the Bank of England. But the phrase is misleading if taken literally. The Bank of England did not collapse. It did not become insolvent. Britain did not lose control of its monetary system. What broke was the government's attempt to keep sterling inside the ERM at that particular exchange rate. Soros had identified a weakness in the policy framework and positioned himself to profit when that weakness became impossible to defend. That distinction is important because the story became a legend about the power of a single speculator. The deeper lesson was about the limits of fixed exchange rates. A government can promise to defend a currency. A central bank can buy its own currency. Interest rates can be raised. Foreign reserves can be spent. But if the market believes that the economic cost of maintaining the exchange rate has become too high, every intervention can become evidence that the defense is weakening. Britain had been caught between two objectives. It wanted a stable exchange rate and an interest rate appropriate for its domestic economy. The ERM made those objectives increasingly difficult to pursue together. Once Britain left, the policy constraint disappeared. Interest rates could fall. Sterling could find its own level. The British economy eventually recovered, and the country did not return to the ERM. The Bank of England's own history describes the episode as a financial crash that followed massive interest rate increases and unsuccessful intervention in the foreign exchange market. Soros therefore did not destroy a healthy system by himself. He recognized that the system was vulnerable, took a position against it, and stayed committed while the authorities attempted to defend it. The market supplied the final force. The most remarkable part of Black Wednesday was not that a billionaire made money betting against a currency. It was that the trade exposed a problem that governments around Europe were struggling to solve. In a fixed exchange rate system, credibility is everything. Once traders believe a government will eventually abandon a currency commitment, the defense itself can become increasingly expensive. Britain had entered the ERM with the pound fixed at a level that became difficult to sustain as economic conditions changed. Germany's monetary policy was being driven by the consequences of reunification. Britain needed something different. The result was a widening conflict between domestic economic needs and the exchange rate target. Soros understood the asymmetry. If Britain continued defending sterling, the government would have to keep using reserves and potentially raise interest rates further. If Britain abandoned the ERM, sterling would fall and the short position would profit. The trade did not require Soros to know the exact hour of the collapse. He only needed to recognize that the existing policy could not comfortably continue. Other investors reached similar conclusions. The pressure became self-reinforcing. More selling required more intervention. More intervention made the reserves finite. Higher interest rates increased the economic cost of defense. Eventually, the government chose to stop defending the boundary. That decision transformed Soros's prediction into a historic profit. It also changed British economic policy. After leaving the ERM, Britain had greater freedom to cut interest rates and operate monetary policy around domestic conditions rather than a fixed exchange rate. The episode became a warning studied by traders, economists, and central bankers. A currency peg can survive bad headlines. It can survive temporary speculation, but it becomes vulnerable when the economic fundamentals and the political willingness to defend it move in opposite directions. Soros later became one of the world's most famous investors, but his reputation from 1992 came from a very specific calculation. He did not know with certainty what the Bank of England would do. He believed that the cost of defending sterling would eventually become greater than the cost of surrendering the exchange rate. On September 16th, that judgment proved correct. The Bank of England had spent heavily. Interest rates had been pushed toward 15%. Sterling still could not hold its floor. At 7:38 p.m., Britain left the ERM. The next day, the 15% rate increase was canceled. Soros bought back the currency he had sold. The profit was estimated at about $1 billion. The man did not break the Bank of England. He found the point where the bank could no longer defend the pound.